Okay, let's dive right in. Did you know something like 60% of homeowners in the U.S. actually have a mortgage?
That's right. It's a huge number, really foundational to how people own homes here.
It is. But here's a fact from the sources that really surprised me, maybe even, counterintuitive.
Uh-huh.
That classic 30-year fixed-rate mortgage,
Mm-hmm.
the one we all think of as standard.
Yeah.
Turns out it's pretty much unique to the U.S. market, especially as the dominant type compared to other advanced economies.
That really says something, doesn't it? About the desire for long-term stability in payments here. It's a core preference.
Absolutely. And figuring out why that is, and importantly, what the other options are, well, that's what we're tackling today. A listener sent us a whole bunch of material, articles, data, research, all about the different kinds of U.S. mortgages you might run into.
It's a complex landscape.
It really is. And picking a mortgage, it's not just paperwork, is it? It's a decision that echoes for, decades. So our mission today is to cut through that complexity.
Yeah, get to the heart of it.
Exactly. We'll pull out the key insights on fixed rate, adjustable rate, FHA, and VA loans based on these sources, aiming to help you feel, genuinely informed.
It's about understanding the mechanics, the upsides, the downsides, and really how each one might fit or not fit your specific financial situation.
Couldn't have said it better. So let's start with the big one, the cornerstone of the U.S. market, the fixed rate mortgage, or FRM.
Right. And the definition is pretty straightforward. With a fixed rate loan, the interest rate you pay, it stays exactly the same for the entire life of the loan.
Locked in.
Locked in. Whether that's, say, 15 years or the more common 30 years, from day one, that rate doesn't budge.
And the big impact of that is pure predictability.
Right.
For your main housing cost.
Absolutely. Your monthly payment for the principal and the interest, that part is constant. It won't change, ever. Makes budgeting for that chunk much, much easier.
Which, as you said, seems to be why it's so dominant here, even if it's unusual elsewhere. People value that stability.
They do. The sources really highlight that preference in the U.S. market.
So how does the actual repayment work? I saw the term amortized used a lot. What does that mean practically?
Okay, amortization. It's basically the payment schedule.
Yeah.
So while your total monthly payment for principal and interest is fixed, the mix of what that payment covers changes over time.
How so?
Well, think about it. At the beginning, your loan balance is at its highest, right? So more of your fixed payment goes towards paying the interest that's accrued on that big balance.
Okay, makes sense.
As you keep making payments, you start chipping away at the actual loan amount, the principal. So over time, the interest portion of your payment goes down and the principal portion goes up.
So it shifts.
Exactly. It follows a predictable schedule, all calculated out from the start. By the very end of the loan, those last payments are almost entirely principal, very little interest.
Got it. Heavy interest up front, more principal later on. Are there fixed rate loans that don't follow this pattern?
The sources do mention a couple of less common types, yeah? Things like balloon loans.
Balloon?
Yeah, where maybe you pay only interest for a while or smaller principal payments, and then the entire remaining principal balance is due all at once in a big lump sum, the balloon maybe after 5 or 7 years.
That sounds risky.
It can be. Or interest-only loans, where you just pay the interest for a set period, maybe 10 years, and then your payments jump up significantly because you have to start paying back the principal over the remaining term. These aren't typical for most home buyers and have different risk profiles.
Right. So sticking with the standard amortized FRM,
Yeah.
what's the big win for the borrower? Why is it the default choice for so many?
Stability, stability, stability. We keep saying it, but that's the core benefit. Your principal and interest payment is locked for the entire term. Budgeting is simpler. And crucially, you're protected if market interest rates go up after you get your loan. If you lock in at, say, 6% and market rates climb to 8% or 9%, yours stays put at 6%. That's a huge peace of mind.
Yeah, locking in a low rate feels like a major victory. What's the flip side? Where's the catch for the borrower?
The main disadvantage bites you if interest rates go down significantly after you've locked in your fixed rate.
Right. You're stuck paying the higher rate.
Exactly. You don't automatically benefit from those lower market rates. The only way to usually capture that benefit is to refinance.
Which means getting a whole new loan.
Yep. Go through the application process again, credit checks, paperwork, and importantly, paying closing costs all over again, which can be thousands of dollars. So you trade that potential upside for the certainty.
Stability costs flexibility in a way.
Yeah.
How about for the lender? What's their perspective?
For lenders, fixed rate loans mean a nice, predictable income stream for years. That's good, but they're taking on the interest rate risk.
Meaning?
Meaning, if they lend you money at 5% fixed for 30 years, and then market rates shoot up to 8%, they're still only earning 5% from you. They miss out on lending that money out at the higher current rate. It's the opposite risk profile to the borrower.
Okay, that makes sense. That's the bedrock, the FRM. Now, let's shift gears to the more dynamic option, the one where things do change. The adjustable rate mortgage, or ARM.
Right. The ARM. It starts out feeling like a fixed rate loan because the interest rate is fixed for an initial period.
Okay, so it doesn't adjust right away.
Correct. There's an initial fixed period, but after that period ends, the rate becomes variable. It can go up or down, adjusting periodically based on what's happening in the market.
And the appeal there?
Yeah.
Is it usually a lower starting rate?
That's generally the main draw, yes. Historically, and the sources noted this was happening again in late 2022, ARMs often have a lower interest rate during that initial fixed period compared to a 30-year fixed loan taken out at the same time.
How much lower are we talking?
Well, the example given was when 30-year fixed rates were hovering around 7%, the initial rate on a common ARM, like a 51 ARM, might have been closer to 6%.
A full percentage point lower. That's significant on a mortgage payment.
It absolutely is. It means lower initial monthly payments, which can really help with affordability upfront, especially when fixed rates are climbing.
I saw that ARMN applications apparently more than doubled in 2022 as fixed rates rose. People were clearly seeking that initial relief.
Exactly. That data point shows how market conditions drive borrower choices. That kind of surge in ARM popularity hadn't really been seen since, well, the lead up to the housing crisis over a decade earlier.
Okay, let's break down the structure. You mentioned a 51 ARM. What do the numbers mean?
Good question. It's pretty simple. The first number, the 5-FIT, in a 51 ARM tells you how many years the initial interest rate is fixed.
5 years, okay.
The second number, the 1-FUT, tells you how often the rate can adjust after that fixed period is over. So in this case, it can adjust once per year.
Are there other common types?
Oh, yeah. You'll see 71 ARMs, 7 years fixed, then annual adjustments, or 101 10 years fixed, then annual. You might even see something like a 56 ARM, where it adjusts every 6 months after the first 5 years.
And the total loan length is usually still 30 years.
Typically, yes. So take that 51 ARM example. You get 5 years fixed, and then potentially 25 years where your rate could change every single year.
Wow. So for most of the loan's life, your payment is potentially uncertain. That feels like a strategic gamble, almost.
It really is. The sources frame it that way. Choosing an ARM is often a calculated risk. You're either betting that your income will rise enough over those initial fixed years to handle potentially higher payments later, or you're betting that you'll sell the house or refinance it to a fixed rate loan before that first adjustment hits. You plan to get out before the variability kicks in.
Okay, let's get into the mechanism. When the rate does adjust, how is the new rate figured out? What determines it?
This is the crucial part to understand. The adjustable rate is made up of 2 pieces, the index and the margin.
Index. Sounds like something tied to the wider economy.
Exactly. The index is a benchmark rate that reflects general market interest rate levels. Think of it like a financial barometer. Common indexes are tied to things like U.S. Treasury yields, and these indexes move up and down with economic conditions.
So when the Federal Reserve raises interest rates,
That tends to push these indexes higher, which means when your ARM adjusts, if the index it's tied to has gone up, your interest rate is likely going up too, and so will your payment.
okay, index is the moving part. What's the margin?
The margin is the lender's piece. It's a fixed number of percentage points that the lender adds on top of the index rate. This margin is set in your loan agreement from day one, and crucially, it doesn't change for the entire life of the loan.
It stays the same.
The margin itself does, yeah. The sources mentioned the average margin on 51 ARMs has been around 2.75 percentage points for quite a while. So your new rate is basically current index value plus your fixed margin.
Index plus margin. Got it. That sounds like it could lead to some serious payment shock if the index shoots up. Are there any safety nets? Limits?
Yes, thankfully. Modern ARMs, especially post-crisis ones, have rate caps built in. These limit how much your interest rate can increase at each adjustment and over the lifetime of the loan.
How do they work?
Typically, there's a cap on the first adjustment after the fixed period ends. Then there's a cap on how much it can change in any subsequent adjustment period, usually annually. And maybe most importantly, there's a lifetime cap.
A ceiling.
Exactly. It sets the absolute maximum interest rate your loan can ever reach, no matter how high the index goes. Often, this lifetime cap is something like 5 or 6 percentage points above your initial starting rate. It gives you a known worst-case scenario, though some research cited suggested borrowers don't always fully grasp how high rates could go within those caps.
Do the rates only ever go up? Or can they adjust downwards too?
Oh, they can definitely go down. It all depends on the index.
Yeah.
The recent environment, as the sources noted leading up to late 2022, saw the Fed raising rates, so indexes were generally trending up.
Right.
But the sources gave a counterexample.
All right.
If you'd taken out a 51 ARM back in, say, April 2010 when rates were low, by the time your first adjustment came around 5 years later, the relevant indexes were actually near zero because the Fed had kept rates extremely low. In that situation, your payment would have actually decreased. Ah, okay. So it truly reflects the market direction. Now, you mentioned the housing crisis. It sounds like ARMs back then were different and riskier.
Hugely different.
Right.
The sources paint a stark picture. Back in 2006, something like 90% of subprime mortgages loans to borrowers with weaker credit were ARMs.
90%? Wow.
And the way they were underwritten was, well, let's just say standards were lax. People got loans with low scores, lots of existing debt, sometimes with little proof of income or assets. You heard terms like stated income or no-doc loans.
Right, I remember those terms.
Plus, the ARMs themselves often had very short fixed periods, maybe just 1 or 2 years, before facing potentially massive rate hikes.
So when those short periods ended and rates reset higher?
Defaults and foreclosures skyrocketed. The research cited was pretty clear. One study found that just a 1 percentage point rate increase at reset boosted the odds of foreclosure by 2.5% in the following year. Combine that with weak underwriting and borrowers with no cushion, it was a recipe for disaster. A major factor in the whole crisis. But you said regulations change things. How are ARMs safer today?
This is key. The Dodd-Frank Act, passed in 2010 in response to the crisis, really overhauled mortgage lending. It introduced the ability to repay rule.
Meaning lenders have to actually check if you can afford the loan.
Yes, and not just the low initial teaser rate. They have to assess if you can afford the payment based on the fully indexed rate, the index plus the margin, considering potential increases up to the caps. They have to verify your income, assets, debts much more thoroughly. Risky features like no-doc loans were largely eliminated.
And disclosures improved too.
Dramatically. Lenders have to provide much clearer information about how the ARM works, including payment scenarios showing how much it could increase. Plus, banks are required to hold more capital now, making the whole system more resilient to shocks.
Sounds like important progress. But you also hinted that regulations aren't static.
Well, the sources did note that the regulatory landscape can change. There was a law in 2018 that rolled back some parts of Dodd-Frank, and a court ruling in 2022 affected reporting rules for some smaller banks. It just highlights that while big reforms were made, the specifics can evolve, so staying informed is still important.
A good reminder. Thinking beyond the individual borrower. What happens to communities when lots of people face payment shocks they can't handle?
That has ripple effects. The sources mention things like deferred home maintenance people can't afford upkeep, so properties deteriorate. And there was a study cited from Milwaukee showing that areas with more tax-delinquent properties saw nearby home values decline. It impacts everyone in the neighborhood, not just the person struggling.
Right, it's all connected.
Yeah.
So if someone has an ARM now and rates are climbing, what's their main escape hatch?
Refinancing. If market conditions allow, meaning fixed rates are attractive, and if you qualify based on your current financial situation and home equity, you can refinance out of the ARM and into a stable fixed rate mortgage. You're not necessarily stuck for the entire variable period.
Though you'd have closing costs again.
You would, yes. That's the trade-off.
Okay, fixed versus adjustable, stability versus potential change. Now, let's look at the government-backed options designed to help more people get into homes, FHA loans.
Right. FHA loans are insured by the Federal Housing Administration, which is part of HUD, the Department of Housing and Urban Development.
They insure the loan, not make it.
Correct. Private lenders make the loan, but the FHA provides insurance that protects the lender if the borrower defaults. This encourages lenders to approve borrowers who might not meet the stricter requirements for a conventional loan, often people with lower credit scores or less money for a down payment.
And the defining feature seems to be this thing called mortgage insurance premiums, or MIP. Yeah. That's an extra cost for the borrower.
It is, and it's a major difference from conventional loans. With FHA, you pay mortgage insurance no matter how much you put down.
Yep.
Conventional loans only require private mortgage insurance, PMI, if your down payment is less than 20%.
And FHA MIP has two parts.
Yes. There's an upfront mortgage insurance premium, the UFMIP, paid at closing, and then there's an annual insurance premium, which is actually paid monthly as part of your regular payment.
Let's take the upfront one first, UFMIP. How much is that?
The sources indicate that for most FHA loans originated since late 2010, the UFMIP is typically 1% of the loan amount. So on a $200,000 loan, that's $2,000.
And you pay that at closing? Or can it be rolled into the loan?
You can pay it in cash, but most people finance it, meaning they add it to their loan balance. The lender then has to send that payment to FHA pretty quickly, within 10 days.
Okay, you pay upfront. Can you ever get that money back? Like if you sell or refinance?
This is where the rules got tricky, and the sources were specific. Years ago, partial refunds were common. But for loans closed since December 2004, refunds are basically gone unless you refinance from one FHA loan directly into another FHA loan.
Only FHA to FHA.
Yes, and even then, it's not a cash refund. It's usually a credit applied towards the UFMIP on the new FHA loan, and the credit amount decreases depending on how long you had the old loan, typically over a 3-year schedule based on the source details. So for most people, that upfront premium is a sunk cost.
That's a really crucial point. Okay, so that's the upfront piece. What about the annual MIP, the monthly part?
Right, that's the ongoing insurance cost. It's calculated each year based on factors like your original loan-to-value ratio and the loan term, but you pay it in 112th increments with your monthly mortgage payment.
And that rate can change too.
The rate itself is set based on when you took the loan, but FHA has adjusted the premium levels over time. The sources mentioned an increase back in 2011 of 25 basis points, or 0.25%. They gave an example showing this added about $33 a month to a typical loan payment at the time. Small percentages add up.
Definitely. Now, the big question, does this monthly MIP ever go away? Or are you stuck with it forever?
It can go away automatically, but the rules are very specific and depend on your loan terms and origination date. For most standard FHA loans taken out since 2001 with terms longer than 15 years.
Yeah, the common 30-year FHA.
Exactly. For those, the annual MIP will only cancel automatically when 2 conditions are met. First, your loan balance reaches 78% of the original value of the home. Second, you must have paid the annual MIP for at least 5 years.
Both conditions have to be met.
Both. 5 years of payments and reaching 78% LTV. There are slightly different rules for shorter-term loans, but for the typical 30-year FHA, that's the hurdle.
And that 78% LTV, how is that calculated? Is it based on today's home value if it's gone up?
No, and this trips people up. The sources are clear. It's 78% of the lesser of the original purchase price or the appraised value at the time you got the loan.
So appreciation doesn't help you cancel MIP faster?
Not for the automatic cancellation rule, no. If the home was worth $200 when you bought it, the MIP potentially cancels when the loan balance hits $156K, assuming you've also paid for at least 5 years on a loan over 15 years. What the house is worth today doesn't factor into that specific calculation.
Wow. So for many people with low down payments on a 30-year FHA, that monthly MIP could stick around for a very, very long time, potentially the life of the loan, unless they refinance out of FHA altogether.
That's often the reality, yes. It's a significant long-term cost compared to conventional PMI, which is removable based on current equity.
Are FHA loans only for first-time buyers?
Nope, that's a common misconception the source has clarified. Repeat buyers can absolutely use FHA loans, too, for purchases or refinances.
Good to know. Okay, FHA helps with access, lower credit scores, smaller down payments, but comes with potentially long-lasting mortgage insurance costs. Let's move to the other big government-backed option, VA loans.
VA loans. These are guaranteed by the Department of Veterans Affairs, again, offered through private lenders. They're specifically for eligible service members, veterans, and some surviving spouses.
And the big advantages.
Usually, the ability to buy a home with 0 down payment, that's huge. And typically, no ongoing monthly mortgage insurance requirement like FHA MIP or conventional PMI.
0 down and no MI. That sounds amazing. How do you qualify? What's the first step?
The absolute essential first step is getting your Certificate of Eligibility, or COE, from the VA. This is the document that proves to the lender you meet the VA's service requirements.
So the COE is key. Does having one guarantee you get the loan?
No, not automatically. You still have to meet the lender's own criteria for creditworthiness, your credit score, your income, your debts, and you generally have to intend to live in the home as your primary residence. The COE just confirms your eligibility for the VA benefit itself.
Right. So how does the VA decide who gets a COE? What are the service requirements?
It really depends on when you served, the length of service, and the character of service. The rules vary quite a bit by era.
Like how?
Well, for someone on active duty now, it might be 90 continuous days. For veterans, it could be 24 continuous months, or shorter periods like 90 days during specific wartime periods, or 181 days during peacetime, depending on the dates. The sources list out these different requirements.
Are there exceptions for shorter service?
Yes. A key one is if you were discharged due to a service-connected disability. That can grant eligibility even if you didn't meet the minimum time requirement.
What about National Guard or Reserve members?
They're eligible too, but under specific criteria. Usually it involves either 90 days of non-training active duty or completing 6 creditable years in the Guard Reserves and having a certain status or discharge type.
What if someone didn't meet the minimum time for other reasons, or had a discharge that wasn't fully honorable?
The sources cover this. There are exceptions for things like hardship discharges, discharges for the convenience of the government if you served a certain portion of your enlistment, involuntary reductions in force, or certain medical reasons. As for discharge status, things like other than honorable or bad conduct don't automatically disqualify you. The VA reviews those cases individually, and there might be routes to eligibility through discharge upgrades or a specific VA review process.
Good to know it's not always black and white. Who else might qualify besides the service member or veteran?
Surviving spouses are a major group. Eligibility often depends on whether the veteran died in service or from a service-connected disability, or if the spouse receives certain VA benefits like DIC, or if the service member was MIA or a POW. There are also some other less common eligible groups mentioned, like certain WWII Allied Forces members, Public Health Service officers, cadets, EDO-AA officers, and even some WWII merchant seamen.
It's a broader group than many realize. What if someone used their VA loan benefit before? Can they use it again for another house?
Yes, absolutely. It's often reusable through something called entitlement restoration.
How did that work?
Usually, you can get your full entitlement restored if you've sold the home bought with the previous VA loan and paid off that loan entirely, or if another eligible veteran assumes your old VA loan. There's also a one-time option to restore entitlement if you've paid off the loan but still own the property. And even if you don't get full restoration, you might still have some remaining entitlement you could use towards another VA loan.
So it's potentially a lifetime benefit you can reuse. Are there VA loans for things other than buying a home?
Yes, the sources briefly mentioned a few. The most common is probably the IRRL Interest Rate Reduction Refinance Loan, often called the VA Streamline. It's a simple way to refinance an existing VA loan to get a lower rate or switch from an ARM to fixed. There are also VA cash-out refinances and a specific program for Native American veterans buying on trust lands.
Okay, that covers the VA landscape well. Now let's bring it back and do that direct comparison. FHA versus conventional loans. This feels like where a lot of decisions get made.
It often is. Conventional loans are your standard non-government-backed mortgages. FHA is the main government-insured alternative for people who might not qualify conventionally. Comparing them highlights the trade-offs.
Right, so factor number 1, minimum credit score. Big difference here.
Huge difference. Generally, for a conventional loan, you're looking at a minimum score of 620, and often lenders want higher scores for the best terms. FHA is much more forgiving. The sources state you can potentially qualify with a score down to 580 if you have a 3.5% down payment, or even 500 if you can put down 10%. That's a major door opener for FHA.
Okay, credit score is a big one. How about debt-to-income ratio, DTI?
FHA can be more flexible here too sometimes. Conventional loans typically cap DTI around 45%, maybe 50% in some cases. FHA's general limit is often cited around 43%, but the sources suggest that with other positive factors, they might approve DTIs up to 50% or even a bit higher. It offers a little more wiggle room potentially.
And down payment. Conventional needs 20% to avoid PMI, but can you put down less?
Absolutely. Conventional loans are available with as little as 3% or 5% down. The catch, as you said, is you'll pay private mortgage insurance, PMI, until you hit 20% equity. FHA requires either 3.5% down for 580-plus scores or 10% down for 579 scores. So the minimum cash needed up front can actually be similar or sometimes even lower for conventional.
Interesting. What about the maximum loan amount?
Generally, conventional conforming loan limits are higher than FHA limits in most parts of the country. The sources gave 2025 examples, maybe around $806K for conventional versus $524K for FHA in typical areas, though both go up in high-cost regions. If you need a really large loan, you'll likely be looking at conventional, possibly a jumbo loan.
Let's circle back hard on the mortgage insurance. FHA's MIP versus conventional's PMI. You said this is key.
It's a massive difference in long-term cost. FHA MIP required on all loans regardless of down payment. And on most loans, less than 10% down, that monthly annual MIP often lasts for the life of the loan unless you refinance.
Right, stuck with it.
Conventional PMI, only required if you put down less than 20%. And critically, it's removable. You can request cancellation at 80% loan to value based on the original value, and it automatically cancels at 78%. That ability to get rid of the monthly insurance payment is a huge potential saving over the years with conventional loans.
That removability sounds like a true game changer. What about appraisals? Any difference?
Both require one. Conventional appraisals focus mainly on establishing value for the lender. FHA appraisals are generally stricter. They have to be done by an FHA-approved appraiser and follow specific HUD guidelines, which include checking for certain minimum property standards related to health and safety.
Can that cause issues?
Sometimes. The sources mention that the stricter FHA appraisal might take longer or flag required repairs, which could occasionally make sellers in hot markets prefer offers with conventional financing for a potentially smoother closing.
Okay. And lastly, interest rates themselves. Is one typically lower?
It can vary. The nominal interest rate might sometimes be slightly lower on an FHA loan, especially for borrowers with lower credit scores, because the FHA insurance reduces the lender's risk. However, there's a big but. You have to compare the annual percentage rate, the APR. The APR includes not just the interest rate, but also lender fees and, crucially, the cost of mortgage insurance. Because FHA has that upfront UF MIP and the ongoing annual MIP, the FHA loan's APR is often higher than the APR on a comparable conventional loan, even if the starting interest rate looks lower. Always compare APRs to see the true cost.
Great point. So pulling it all together, who should lean FHA and who should lean conventional?
Based on everything in the sources, FHA is likely a better fit if your credit score is below that 620 conventional minimum, if you need the absolute lowest down payment option, that 3.5% with a 580 plus score, or perhaps if your DTI is pushing the limits for conventional, it's designed for access when conventional is out of reach.
And conventional?
Conventional is generally better if you have a stronger credit score, 620 plus. If you can make a larger down payment, even 5% or 10% can get you better terms in that removable PMI. If your debts are comfortably within limits, or if you're buying a more expensive home that exceeds FHA limits. And again, that removable PMI is a major long-term financial advantage if you put down less than 20%.
That really clarifies the decision tree. It's about matching your profile on the home price to the loan's specific rules and costs.
Exactly right. There's no single best loan, only the best fit for you.
Okay, let's wrap this deep dive up. Why is all this detail about different mortgage types so crucial for you, the person listening right now?
Because, let's face it, choosing a mortgage is probably the biggest financial decision most people ever make. The type of loan dictates your payment stability, your total cost over decades, maybe even whether you can get approved at all. Understanding these distinctions, the rock-solid predictability of fixed versus the potential swings of an ARM tied to market rates, the doors opened by FHA and VA, but with their unique costs and rules, it just empowers you.
How so?
Well, knowing the specifics like how FHA MIP cancellation really works, or the exact service needed for a VA COE, or the ARM rates or index plus margin means you can ask smarter questions. You can actually compare loan offers beyond just the advertised rate. You can factor in lifetime insurance costs versus removable ones. It helps you avoid pitfalls and make a choice that truly works for your financial future.
It really boils down to being an informed borrower, doesn't it? In this really complex mortgage world.
It absolutely does.
We've covered a lot today, from that unique American preference for the 30-year fixed to the mechanics of ARMs and how they've changed post-crisis, and digging into the vital details of FHA and VA loans.
Yeah, we saw how history shaped ARM regulations, making them different today, though still carrying risk. And we got into those crucial, often missed details about government loans, FHA insurance rules, VA eligibility nuances. It's a lot to navigate.
It is. And thinking about it, given the dominance of the fixed rate here, the comeback of ARMs when rates rise, and all these specific government program rules, what does that say about buying a home in the U.S. today? Does all this complexity, this interplay between markets and regulations, make finding the right mortgage more critical, maybe even more challenging than ever before? And, how will these things keep shaping who gets access to home ownership and under what conditions? It really drives home that understanding the whole picture way beyond just the interest rate is just essential.
That's a great point to ponder. The journey is definitely more than just finding the house itself. It's about deeply understanding the financial engine that gets you there.
Absolutely. Well, thank you for sending in the sources that fueled this deep dive into U.S. mortgage types. We hope breaking down these options helps. And remember, this understanding is the first step. Always consult with qualified mortgage professionals and financial advisors to see how this applies to your specific situation.
Definitely. Expert advice tailored to you is key.
For now, that concludes this deep dive. We'll catch you next time for another exploration of the information shaping our world.